Hello, everybody, and welcome to episode 2 of Fundamental Fridays. So, we've had a really interesting week this week in the markets. We've had some really important data come out for the United Kingdom, which has actually caused markets to push back their expectations of interest rate cuts by the Bank of England. And many analysts and strategists are suggesting that the pound could get really strong moving forward into 2020, as long as there is a smooth transition with the EU and the UK departing, with Brexit set to take place on the end of December of this year. We've also had some really important data come out for Australia, New Zealand, and we've also had this outbreak of this virus in China, which has actually caused commodity prices and stock markets to fall in value because of the fears of a worldwide epidemic this could cause if the virus does spread. And we had some reports of it getting to the United States, which made investors quite nervy. As a result, we've seen the Japanese yen be affected and strengthen through safe haven demand, which should reverse because the stock market's falling lower has nothing to do with economic data, more to do with human animal spirits, to do with the fears of the virus. So this could really present some really great trading opportunities moving forward. So what we'll do is we'll go over to the computer screen, have a look at what we've seen this week, and we'll also have a look at our scorecards and our endogenous analysis for many of the currencies that we're analyzing, and then we'll see how this can potentially generate some good trading opportunities moving forward. So I'll see you over on the computer screen for episode 2. Thank you. Hello traders, and welcome back to the computer screen. So starting off, traders, we're going to run through an analysis of the Great British Pound. We're going to look at the market pricing for interest rate cuts, which has now gone lower. And we're going to look at the outlook for the pound moving forward, with many analysts suggesting that the currency will strengthen because of the capital inflows that will flood into the United Kingdom if the UK and the EU can agree on a smooth transition and a positive trading relationship moving forward after the end of this year. So we had this week, earlier on in the week, we had markets expecting a rate cut from the current interest rate level of 0.75%, and markets were betting for an additional rate cut down to 0.5%. And earlier this week it was up around 80% that the markets were betting that the Bank of England would be cutting interest rates because of some really weak data coming across the economic calendar previously for the United Kingdom. But this week for the UK, we had some positive news in terms of employment data came out positive for the United Kingdom. And as we know, employment is very, very important because it literally is a building block to create an environment for growth, inflation, and maximum employment. And we had good employment data, which kind of eased market expectations that the Bank of England would be committed towards cutting interest rates. And then today we had even more important economic data. We had leading PMI and services data, which is a tool which is used to predict economic growth in the United Kingdom with an 85% certainty. This is why when you see manufacturing PMI data, services PMI data, it's a 3-ball flag event, because these are the main economic indicators that investors, professional traders, hedge funds, investment banks, policymakers in government and in the central bank monitor very, very closely, because they use these surveys to predict what the economy is going to be doing moving forward. So if you get a reading above 50, that indicates growth and expansion in the economy, and a reading below 50 indicates contraction in the economy moving forward. But with the services PMI, we are above 50 in our reading, which is positive because it's still looking towards growth in the economy. And we must remember, more importantly, with services PMI, this makes up 80% of the UK economy, and manufacturing making up the additional 20%. And this has an 85% certainty in predicting GDP if you go back as long as the data has been released. This is why it's a three ball flag event. So it's a major event that markets are paying close attention to. And the expectations for rate cuts has now drastically been slashed to around 50%. So there's still a probability that the Bank of England will be cutting interest rates, but the markets are now less certain towards a rate cut because the leading indicators are predicting that the UK economy should start to perform better, or the slowdown may have bottomed out. And we understand why the UK has been slowing so much, because the uncertainty around Brexit has made investors quite cautious towards pumping money into the United Kingdom. Because if you're an investor and you want to invest in companies or start your own businesses, they want to first make sure they understand the relationship between the UK and the EU moving forward, because they want to understand what kind of tariffs and taxes will be imposed on each other's goods and services once a trade deal is agreed. And if there wasn't a trade deal and there was a hard Brexit, then of course this would affect the flow of goods and services, and it could affect company profits. So there's been a lack of investment in the UK, and as we know, that does stifle economic growth, employment, so on and so forth. But the data is really good at the moment in terms of improving leading economic indicators. And then when we had a look at what the forecasters are predicting for the Great British Pound moving forward, they're saying that the pound is predicted to go up around 3% against the US dollar. Some are saying 7% against the US dollar. And what they're pointing towards is capital coming back into the United Kingdom. And of course, this is inflationary. This means the economy can expand and grow, because if businesses are starting to receive more investment, then you can expect higher employment levels and stronger levels of growth. Now, other analysts are suggesting that the pound could go up by as much as around 7% into 2020. And this again is based on the analysis that the UK is going to see a lot of capital coming back into the country. And then this analyst is predicting the pound will go up against the dollar to 140 in the exchange rate. So that's quite a strong move from where the pound is currently trading at the moment. So if I take you over to the pound dollar exchange rate, you can see this is leading up to a move to around 140 from the current price. So we would expect the pound to appreciate against the dollar by around 7%. So that's quite a big move in the markets. And we must remember, the more money that comes into the United Kingdom, the Great British Pound would be in high demand, because when you're buying the pound and you're an investor from overseas, so say for an example, you're an investor from the United States and you're trying to invest in the UK, you have to sell your US dollars in exchange to buy the British pound, and this flow of money into the pound is causing the pound to be in a higher demand relative to the US dollar, and we will see the pound rise in the exchange rate. So if UK investment does really start to pick up in 2020, if investors do have the confidence that the UK and the EU can agree on a comprehensive trade deal, then we could expect the pound to rally higher. So now when we were doing our endogenous analysis of the United Kingdom and we had a look at our scorecard, now this is a system used by hedge funds, investment banks, where you basically look at the main economic drivers in an economy and you're scoring for each indicator the maximum amount of inflation or deflation that each economic indicator is predicting, and then you add up your scores at the end and you get to a final score as to how inflationary or deflationary the data is. So you have a maximum score out of 10, so you can have 0 to 10, meaning an inflationary score from 0 to 10, or you can have a deflationary score from 0 to -10. So we have the leading economic indicators in the United Kingdom, and this was more deflationary previously. So this basically is what the markets use to predict what's going to be happening in the United Kingdom, and it was actually quite deflationary before. So it was predicting the UK economy was going to be deflating and not growing at the normal pace, which was why when I showed you over here, we had markets really betting that the Bank of England would be cutting interest rates to try to support the economy, lower borrowing costs, increase the money supply, and get money into the system and try to get the economy kick-started. Because remember, if interest rates are going lower, people have lower debt payments on their credit cards, student loans, mortgages, for an example, and it sets the environment for spending and borrowing to increase. And of course, that means that there will be a pickup in demand for goods and services, employment levels will rise, inflation will rise, and that will help drive up growth in the United Kingdom. So at the moment, the situation is improving, so we have a less inflationary bias. So when we add up our scores, we only have a -1 score at the moment. And then, of course, the government is reacting by trying to inflate the economy, and we have quite an inflationary bias coming from our balance sheet and sovereign risk from the central bank and the government. And this is what the government is doing in reaction to what the leading economic indicators are predicting. Because remember, these are the economic indicators that the central bank and the UK government are politically motivated to making sure that they achieve maximum employment and steady price inflation of around 2%. And they do that by controlling interest rates and the money supply. So we have a better score for the United Kingdom. And if we do a relative analysis, when we look at the United Kingdom against other countries like Australia, which we're going to go have a look at in a moment, we're now having a stronger bias towards buying the pound against the Australian dollar, for an example, because we're having a more inflationary bias towards the United Kingdom relative to a deflationary bias in Australia. And I'll show you in a moment how markets are betting on rate cuts in Australia to be coming through. And then we understand when we look at interest rate differentials, why that can support the pound to probably move higher on a relative basis against the Aussie dollar. Because remember, if you're having inflation in the United Kingdom and deflation in Australia, what this is basically telling you, you're likely to have a tightening policy response in the United Kingdom relative to a loosening policy response in Australia on a relative basis. This doesn't mean that's going to happen, but that's how you draw a bias towards an exchange rate such as the pound against the Aussie dollar. So that's an interesting analysis for us to look at. So this is how we generate trade ideas in the markets, and this is how we can generate whether we want to be buying or selling an exchange rate. So that's for an inflationary score for the United Kingdom. So we want to be long the pound against the Aussie dollar. And if you move across the scale, we have a similar analysis for the pound against the Canadian dollar. We have a similar analysis for the pound against the Swiss franc, so on and so forth. And we can see when moving across the scale that we have a bias towards buying the pound. And this is why many analysts are suggesting the pound should go higher. And when you do a proper education on currency analysis, we understand when money is going to be flooding into the UK and you're looking at the balance of payments in relative to each other, then you understand that as the rest of world currency reserves of pounds are depleting because they're sending money into the UK to invest in the UK, then the exchange rate should be appreciating in the UK, in sterling's favor, and we should see a stronger pound. But this is more to do with deep macroeconomic analysis, but this is just how we generate trade ideas in the markets, and then we use for an example, our technical analysis strategy to try to get into the market and then profit from these endogenous and our exogenous analysis. So that's looking at the UK, which is interesting. So we could see the pound actually into 2020 start to rise should market expectations pull lower for rate cuts. And for an example, if there is looking like there's going to be a smooth transition with the UK leaving the EU, then if we look at the bigger picture, we have seen the pound trending higher against the dollar, for an example, and many other currencies. And if capital does continue to flood into the UK, then this trend should continue, because remember, if you're an investor in Japan and you want to go into the United Kingdom and invest, you're selling your yen into pounds, and this flow of money into the pound is causing the currency to be in a higher demand, and we see the currency rising in the exchange rate. So that is our analysis of the pound for this week. And now we move on to the Australian dollar. So earlier this week, when we looked at the Aussie dollar, we had on Tuesday in Australia, on Thursday, my apologies, we had employment data in Australia, which actually came out quite positive, which is good. And then we had also for Australia, the PMI data that came out, but still below the reading of 50. So again, that is indicating contraction in the economy. And then when we look at our scorecard for Australia, we still have a deflationary score, which is why if I take you over to this website and you can see the market pricing for interest rate cuts. The interest rate in Australia is currently 0.75%, but markets are betting on a rate cut down to 0.5% by around May or June of this year. So the bias is still towards deflation in the economy. So the central bank is going to be cutting interest rates to try to support the economy. But as we know, lower interest rates makes the currency less attractive, which is why we have a short bias towards selling the currency on that understanding. So we understand that the Aussie dollar is likely to weaken less than strengthen unless there is a turnaround in data moving forward, especially the leading economic indicators. So if, for an example, in Australia, we have moving forward manufacturing PMI going above 50, indicating there's going to be growth. Same with services. If consumer confidence picks up, then this could change the outlook for the leading economic indicators, and if they become less deflationary and become more inflationary, so say if we have a score of -12 and we go towards a score of 0 and then into a positive inflationary score, then maybe the central bank will ease its bias towards rate cuts. But at the moment, if we're looking at the coincident economic indicators, which are suggesting what's happening in the economy now, we can see we do have deflationary conditions in Australia, and this is why we have a strong inflationary response by the central bank trying to generate growth in the general economy. So at the moment, we definitely have a short bias towards the Aussie dollar. We don't want to be buying this currency right now relative to other currencies which have a more of a positive outlook moving forward. We also had this week New Zealand data come out on Thursday. So we had CPI inflation data, which came out quite positively. But again, if we go ahead and we look at New Zealand's score in our scorecards, it again has quite a deflationary bias towards low levels of growth at the moment. So we don't really have a strong bias towards buying the New Zealand dollar either at the moment until we have more of a positive outlook for New Zealand's economy moving forward. So you can see how important it is to understand how to analyze the macroeconomic data and interpret it in the correct way. And as we see, we have a low inflationary score of 3. And this is why we haven't really seen a very strong New Zealand dollar since 2018. We've actually seen it weaken quite considerably. And this has been in conjunction with interest rate cuts by the New Zealand Central Bank. So that's just touching on the key data that came out this week. We also had European data came out today, and it was better for the leading economic indicators such as manufacturing PMI just edging a bit higher, and the services PMI came a bit lower but still above the reading of 50. But we know that now the central bank in Europe is already pumping excess money into the economy to try to stimulate growth and inflation in Europe, and as we know, this devalues the purchasing power of euros in circulation, hence why the euro has been very, very weak since 2018. So if you look at the euro, when we look at the bigger picture of the trend, it's really weakened even against currencies like the yen, which have very low interest rates themselves. So unless there can be a pickup in data for Europe, it's likely to keep the euro under pressure. But unless we get a turnaround in data, and if European data can improve and the outlook becomes more positive, then you may see a stronger euro moving forward, because markets will expect that the ECB may move away from their loose policy of excess money being pumped into the economy, and that could strengthen the euro if the growth outlook improves. So also touching on some interesting developments this week, we've seen the Japanese yen get stronger in the markets, and we've seen commodity prices dropping, and we've seen stock markets also falling lower. Now this is because of the outbreak of this virus in China, and especially commodity prices have been falling, as we can clearly see. And this is because if there is an epidemic of this outbreak of a virus, this could hit oil demand, and we are seeing oil prices slump on this news, and it's not looking positive for the oil market at the moment. And it's more to do with fears of this virus spreading than a complete drop in demand caused by a slowing economy at the moment. So you could say this is investors overreacting. And as we know, the Japanese yen is a safe haven currency, so it does appreciate in times of when there's risk off sentiment in stocks or commodity markets. And we're seeing the yen in a high demand. But we must remember, with negative interest rates in Japan, the yen is always used as a funding currency to invest into other currencies with a higher interest rate, so you can earn a profit from the difference in interest rates. And with inflation considerably low in Japan, way below the central bank's 2% target, and negative interest rates, then we know these moves in the yen rarely last long, and these could be very, very good buying opportunities in the markets. Now, more importantly, currencies like the Norwegian krona, which we know is a commodity currency because Norway's main export is oil, is the reason why it's falling is because oil markets are dipping lower. Same could be said for the Canadian dollar against the Japanese yen. But look at the bigger picture. We have been moving higher, and this could be a really good buying opportunity. If the markets just calm down from the outbreak of this virus, you can get in and expect the Canadian dollar to appreciate against the yen. Again, the yen's only getting stronger because of the safe haven demand, and you can actually watch my first video for episode 1 where I explain this in more detail about the yen and its safe haven status when it's times of uncertainty in the markets. So that could be some really good trading opportunities if stocks start to move back higher, if commodity prices move higher. We know the yen will weaken because investors will sell off their Japanese bond holdings and they'll start to buy currencies back. Especially currencies like the Canadian dollar. With such a higher interest rate than Japan, you make money by buying the Canadian dollar against the yen, and you lose money when you're selling the yen against the Canadian dollar unless the yen is getting stronger in the exchange rate. So if markets are not buying the yen because of strong fundamental data out of Japan, and it's only because of these risk-off moves, you know these moves don't really last long, and you're more likely to get a rebound. But we did move with the Bank of Canada moving towards a bit of a loosening bias in their interest rate decision this week. So it'll be interesting to see how much markets do pricing rate cuts in Canada. But if these rate cuts are not going to be priced in fairly soon, we could see the Canadian dollar rebound higher against the Japanese yen. So this is something for you to monitor and keep a close eye on, which is interesting. And again, traders, these are the developments for the week. So I hope that all makes sense. And again, I hope you have a great weekend, and I'll see you next week for episode 3. Thank you very much.